Corp. I'm actually a director with the business, and today we actually want to take some time to help you understand traditional lending. We've got a panel of experts today. We have Brian Smith, who is Senior Director of SBA Lending at Capital One. We have Daniel Adams, with Business Banking Manager at Wells Fargo, and we have Peter Izzo, Vice President of Commercial Banking at TD Bank. Gentlemen, I'll actually let you introduce yourselves, give you a little time to explain your background and history before we start answering questions. So do you want to start, Brian?
Sure. Thank you for having me here. I'm so glad and excited to join you today. My name is Brian Smith. I've been in banking for over 15 years in the small business space for all of that time, working with conventional borrowers and with an expertise in SBA lending for over 15 years. So the small business owner, small business customer is my passion, and I'm here to answer your questions and help any way I can.
Great, thank you. What about you, Peter?
Well, I'm Vice President of Small Business and Commercial Banking here in New York City, and I've been working in banking for about 10 years. Prior to that, I was working in the small business segment, managing small businesses, primarily in the food service space, and I enjoy working with small businesses here, helping them achieve their financial goals, and thank you for having me.
Thank you. And Daniel, can you give us a brief introduction?
Hi, yeah. Sure, yes, I'm Daniel at Bank out here in San Diego, and I've been in banking for about 12 years now. Prior to Wells Fargo, was with B of A. Prior to that, I did own my own small business, a little 40-person. And what we do is we really, as the other folks have said, we make the businesses succeed financially. That's our goal.
Absolutely. So it looks like we've all got a vested interest as small business advocates to kind of demystify the difficulty behind getting a traditional loan. I always talk to small business owners who are saying they don't believe that they would qualify for a bank loan, so they're going other places, alternative lenders, to try to get that financing. So I want to start by asking each of you a question. Brian, I'm going to start with you. One of the things that we always get is, how can small business owners best prepare themselves and increase their chances for approval when they apply for loans? So what are you looking for from your borrowers?
Yeah, I think that's a fantastic question, because it's really the jumping off point for your relationship. And just like you're having a job interview, you want to make sure that you're putting your best foot forward. And so what we really look for are small businesses that come with a plan. They know exactly where they are, what they're doing, where they're going. They know their financials inside and out. Some of them have a written business plan. Some of them have their business plan sort of in what they're doing on a day-to-day basis. But really, we're looking for that small business owner that knows where he is and where he's going and can communicate that in that opening meeting. The more documentation that you can bring with you, the better. You're looking, again, to show up in a really big way to that banker at that time and really gain his confidence, or hers.
So I think that's a good follow-up question. When you're saying gain that confidence, what would kind of set you off from someone in terms of their explaining to you about their business, their passion? What would immediately turn you off from being willing to lend to someone like that came in?
Sure. I think that when we're talking to a small business owner, we want them to have that passion. I mean, you are that business, and we really want them to know the numbers, the people, the market, your competitors. These are things that we as bankers end up having to look into and evaluate as we're looking into your loan. Knowing that you know those parameters and those factors about your business even better than we do is a big deal. Conversely, somebody who is uncertain, doesn't know their financial position, doesn't know, what their cash flow needs are, doesn't understand the inner workings of their business, those are people that we lose a lot of confidence in that conversation. And if you're someone who relies upon partners, and a lot of people do and should rely and have their partnerships with accountants, attorneys, etc., then maybe even have that person with you or be able to plug them into the banker at that time. You should still understand the data, the information, but you can also point the person to your partnership, and that can be helpful.
Thank you. Peter, what is the most common mistake that you see businesses make both before and after the loan application process?
Well, kind of building on what Brian's talking about, actually, I think prior to even looking for a loan application, I think the biggest mistake that a small business owner makes is in compiling the financial information. What I mean by that is, the bank can only lend based on what we can see, what's on paper. I think the biggest challenge that I've seen in the small business space for a successful small business owner who might otherwise qualify for a loan is running into challenges because they're presenting financials which aren't necessarily representing their business fairly. What I mean by that is we all know they're making more money than they're really making. Problem is it's not making it to their tax returns. And that goes to the strategic partners and trusted advisors that they choose. I think the most important decision a small business owner could make is in choosing their accountant. I think there is a wide range of accountants out there, and the problem is that too often, an accountant's value proposition, if you will, is I'm going to save you money. And really what they're talking about is they're going to limit your taxable liability. And unfortunately, limiting your taxable liability also has a negative effect of limiting your availability to credit. And, that is one of the biggest challenges. Banking today is not what it was like 30 years ago. It's a highly regulated industry. And if a small business owner, who we know is making more money than the negative $14,000 a year in cash flow they're presenting to us, we can't lend against that because then we have to give that loan to the next person who presents the same tax returns, who, oh, by the way, is really losing $14,000 a year. So I think that's one of the biggest mistakes that is made prior to even looking for a loan is in the years leading up. Then after or entering into the loan application process is you have to understand why you need the loan, understand the purpose of the funds, and don't overreach. I think there's a lot of wives' tales out there about asking for $1 million when you only need 500 because then they'll counteroffer you to 500, and that gets to understanding what Brian was talking about, your business from a financial perspective. What you ask the money for and how much you ask for is important because that demonstrates an understanding of your business from a financial perspective. So I think that's another challenge.
And then how involved do you stay with the actual business owner after the money is lent?
Well, I think next to your accountant and your lawyer, your banker should be one of your key financial advisors, trusted advisors, if you will, because the banker also has what I believe a proper banker should do has access to other clients who could then help your client. So I think there should be, at the very least, depending on the financial needs of the client, I think there should be at least a quarterly conversation with your banker. In a perfect world, a monthly conversation with your banker, even if it's just to touch base, because you're an architect. You own a plumbing and heating company. Managing the financial aspects of your business is not something you have an expertise in. So rely on the folks that have an expertise in managing financial aspects of your business, and they can point you in the right direction. I think a strategic partnership with your banker from the moment you start the process is imperative to any business's success.
Thank you. So, Daniel, I've heard that most banks are interested in lending when you don't need the money. How do you see that? And then when is the right time to actually seek financing for either startup or ongoing business?
Question and your details about what banks look for and how to approach a bank. I would say have a conversation. It may not lead to lending. It may not even lead to a need for lending, but have a conversation with a trusted banker. Banks, but definitely test drive a couple of bankers to make sure that banker is going to be with you for the long term or through the long haul. But again, where we see challenges, where avoidable challenges are where somebody will have, for example, with a startup business, they'll stretch themselves so far, and they'll have access to so many friends and family and home equity, and really they'll be completely over leveraged in other ways that kind of led to the business being funded, but it wasn't really business debt. Almost all banks are going to look holistically, really, as the totality, not just the business, but the person that's the ownership of the business. And again, that's where we see it and say, gosh, I wish we could turn back the clock. I wish you could have come to us a year ago when you were a startup. You had a good business plan, you had great background, great character, great credibility. All these things work. But over the period of time, because you kind of went it alone, you made it a year in, even though now the business is actually going for a year and you have something to base it on, but still, the way you did it for a lot of business owners is, if we could have had that conversation a year earlier, had more of a plan process, and again, like Peter was saying, talk to your CPA, talk to your attorney, that's the third leg of that stool, and say, here's where I want to get in a year, in 5 years, in 10 years, and let's figure out a program. It may not involve lending up front, but set that map, draw out that roadmap early is really what we'd like.
Great. So we talked about what is the most common mistake that you're going to see when you meet with business owners when they're applying for credit?
For me?
For you.
Yeah. I think, Peter again hit it on, is the sometimes across money, hey, it's contingency funding, things of that sort. I just want to have access to funds. The banks and the credit officers, the credit decision makers, they want to make that personal, emotional borrower with the business owner. And when the business owner says, hey, here's what I need, and here's why I need it, and here's what I'm going to do with it, that makes a lot of sense to us. But sometimes, even if all the numbers add up and everything looks great, if there's no clear purpose for what the company's doing, and it doesn't have to be, hey, I've got a purchase order here that I need to be able to execute on, but a plan that says I need X number of dollars to do this, and this is why, that adds so much weight. And as a matter of fact, I would say it's probably oftentimes more important than the pure numbers, is to say, okay, what's your plan, and how can we be a part of that?
So if the business owner comes to you unprepared and doesn't have some of these components, do they get a second opportunity or a third opportunity to sell their particular business to you?
They get the option, because we are dealing face-to-face, person-to-person with other people. The old adage, first impression. You really want to come in with your basically with your game face on that day when you first meet with the bank. Otherwise, if it ends up being a ping pong match back and forth, all of a sudden things start looking like there is no clear plan. It's kind of hard to drip a clear plan. If you have a plan, and present that plan to the banker, and look at the banker more as a partner. It's not an equity investor. I don't want to confuse it. It's lending money with the expectation of getting paid back. But if you have a partner at the banker to business owner level, really a lot more doors open, a lot more opportunities. And frankly, I think Brian and Peter both mentioned it, bankers manage a lot of different customers. They can bring a lot of expertise to that. You may be a startup, for example, but that banker's been through 20, 30, 50, 100 startups. So they can maybe be more of a trusted financial and business advisor and not just a lender, for example.
Thank you. Brian, what should business owners know about SBA loans? How are they different from traditional loans? And what are the key benefits and drawbacks of those types of loans?
That's a great question, because not every business is in the same period in the life cycle. Some of them are very mature, they're making a lot of money, and they're in a position to grow in different ways. Some are just starting out. An SBA loan, in its essence, is for someone who does not qualify for a conventional loan. And so the key there is that there's a weakness in the credit request. Understand I said the credit request and not the business. Your business is as strong as you can make it. But there may be something such as collateral. Oftentimes with SBA lending, the number one use of an SBA guarantee is to make up for a deficiency in collateral. And in that instance, The SBA loan can allow the bank to take that little extra risk because the business is sound, you've come prepared, you've got a plan, your financials show that you know how to manage it. You just lack something that we need, which is collateral. In that instance, we're able to move forward. And so an SBA loan fills the gap between when a business is ready for a conventional traditional loan and when they're not. And we're able to help a lot of businesses. I've been doing that for 15 years, helping small businesses get started. And then one of the most rewarding things is when you look back and you drive by that business every day, you had a hand, and as Daniel said, partnering with them to get to the next step. And then they grow, they add jobs, they invest in the community, and great things happen together. You asked the question, though, what are the benefits and the drawbacks? The benefits are many. Oftentimes with an SBA loan, you'll be able to get a longer term, which means a lower monthly payment. You can put less money down, less cash out of your pocket. That translates into big dollars, depending on, could be a piece of real estate that you're purchasing, and that less money down helps you keep that money in the company, invested in the company, and continue to grow. So collateral, cash down, longer terms equal lower monthly payments. Those are some of the most frequent ways that an SBA loan can benefit you. In addition to the benefits, though, you do have to consider the costs. The costs are a little bit higher interest rate and a little bit higher fee. The fee is charged directly by the SBA itself, and that's passed through to the borrower. So that fee goes to the SBA. It's put into a pool to help offset future losses if there are any. And the rate is really a risk-based rate. So you're not in a position to fully qualify for a conventional loan, so your rate will be a little bit higher to be commensurate with the risk. All in all, they're very competitive. They're at very close market rates. So we're not talking about 18% interest versus 6%. We're talking about 6 versus 6.5 or 7. Those are rough figures. Of course, those are at any point in time the rates can be different according to the markets. But the fact of the matter is, if you don't qualify for a conventional loan, the cost of an SBA loan is far outweighed by the benefits that it can bring you and help your business continue to grow, continue to move forward, and really gain access to capital that you would not otherwise have.
Absolutely. Thank you. I was going to ask you as well, you mentioned having collateral. How important do you think from a startup business is their personal credit history as they come through the doors of the bank, having not run a business before?
Sure. Personal credit is something that's often overlooked by startup businesses. You're an entrepreneur, and so you have a dream. You're wanting to go fulfill it. And listen, we have a passion around helping you fulfill that dream. But when we look at a startup, not only is it your experience in that industry and your business plan, but the only real way for us to look at how you've handled your debt obligations in the past is to look at how you personally have handled debt obligations in the past. And if you have a real poor history, for whatever reason, some of these are brought upon us, some of them are our own making, but if you have a poor credit history, you need to really look into, is this the right time to borrow? Because it will be difficult, very difficult, to borrow money as a startup company from a bank when the credit at that point is such a significant factor within your application.
So is that the largest component from an entrepreneur or sole proprietor coming to you? Is that one of the key components that you're using, or collateral? Is that how do those weigh out?
Yeah, I would say that it's a key component. I wouldn't say that there's any one largest. We look at the holistic application and the borrower. So you're not entirely comprised of one factor, and neither is any small business. So we look at the entire relationship. We look at where they are, whether they have a relationship with us. Obviously that would help. But we're looking at multiple factors, and personal credit is indeed a key element.
Thank you. So, Peter, what are the biggest misconceptions that business owners have when managing loans and lines of credit?
Well, I think the important thing is, and I think at times the challenge with regards to working with small businesses, whether they're within the loan process or have gone through it a couple times or just thinking about it, I think understanding the basic loan structure is something I think small business owners have had difficulty, and I think at times we as bankers kind of make it a little bit more complicated in our explanations than it needs to be. And I always try and simplify it in the sense that, a loan in its pure sense is basically a tripod. When you think of a tripod, you need all three legs for it to stand up. If you're missing any one leg, it doesn't really matter how strong the other two legs are. You have the strongest two-leg tripod in the world, it's not going to stand up. So within that construct, I always try and say, when you go from leg to leg to leg, the first leg I always like to say we start with as bankers is cash flow, which is the can you pay me back leg of the loan. And, that really is the starting point. Does the business generate enough cash to service the proposed debt? And that's pretty basic, and I think that's the one that most folks can understand. The next leg of the loan is something I call balance sheet, which is kind of an all-encompassing term, which is really the overall financial health of the organization and the small business owner or owners themselves personally. Something Brian had alluded to is that the overall financials of the business could be strong and the fundamentals of the business could be strong and the industry, but if the small business owner's personal financial situation is kind of a mess, that's a window not only into how they manage things financially, but it can also, if your personal financial picture is troubling, that can leach into your business financials. And vice versa. If your business is struggling, it doesn't matter how good your personal credit is, eventually it's going to impact your personal credit. Other things like, are you over leveraged? Are you making sound financial decisions personally and from a business perspective? And really what that is, that's the will you pay me back aspect of the loan. You demonstrated good cash flow so you can pay me back, but you're making poor financial decisions so you may not be. The last leg of the loan is the one where the SBA tends to kind of help us out the most, and that is the collateral leg of the loan, which is what happens if you don't pay me back aspect of the loan. And, the collateral leg, I have to be honest with you, is as much symbolic as it is functional, because whenever the small business owner comes to me and says, well, I don't want to pledge my personal assets, I don't want to provide a personal guarantee, the bank is left to wonder, well, if you're not willing to stand behind your business, why should the bank? At the end of the day, the bank doesn't want to own whatever piece of collateral you're pledging. We're really not interested in it. We want to know, though, that you're willing to pledge it because you've got some skin in the game. So that's kind of the construct that I always try and define a loan, and that's always kind of the overarching, theme. Because when someone says, I got this great piece of collateral that I own, I'm like, yeah, that's great. You have this building, you have this home, it's great you're willing to pledge it, but you're not demonstrating an ability to pay back the loan or the size of the loan looking for. So I think the biggest misconception that people have when it comes to loans is that, and also getting to what we discussed earlier, coming to the loan open and honest with your banker because we can help you. We want to do the loan. As a lender, we want to book the loan. We want to have a client. We want to help you achieve your financial goals. We have to make sure that we're mitigating all the proper risks. So don't hide any information. We're going to find out anyway. Know what you need the money for and ask for the right amount of money. And I think those are, when you enter into the process open and honestly, you have a higher ability to get an approval. I think the other challenge from a banker is, the client who actually is making plenty of money and maybe doesn't think they need a loan or a line of credit. And those are kind of the biggest challenges for me, because you see a very successful small business owner and they could grow so much faster with some cheap credit. The difference between working capital and growth capital. We have inventory, we have accounts receivables, and they're turning over fairly quickly. So we're financing those working assets from cash flow, which is our growth capital. Whereas if we provided a line of credit for a small business owner to finance the working capital, that frees up their organic cash for growth, hiring that extra marketing person, hire that consultant, or putting an ad in the newspaper or something to that effect. So I would say, even if you don't think you need a line of credit, everybody has a banker. I think it would be important to sit down and discuss your business with your banker, even if you're not looking for financing, because you may not even realize you could use some financing, I think, is another challenge.
I think it goes back to that cliche term. It's easier to get money when you don't need the money. Maybe you're less stressed at that moment. Maybe you can explain your business. You're more passionate about it. But I've heard that a lot. I love the two-leg tripod analogy. Pretty fun. I like that. Also, I was going to ask you, Daniel, what is the biggest factor that would jeopardize otherwise a really good loan?
You know, that's perfect follow-up to what Peter was just saying, and it's for us, it's character, because character, if everything else is great, in fact, it could be a perfect loan, but and character is going to come through, you know, as Peter mentioned, it's going to come through in your credit report. It's going to also come through in a lot of behavioral measures. On the business side, it'll be the D&B report. That what character really is to a bank. It says everything looks good when we're going into this. You know, this all makes sense financially, but at the end of the day, every month, at the end of the month usually is how it works out, but you need to make a decision whether or not you're going to pay back that loan or not. So everything could work out great, but if we don't, and then again, that ties into the personal emotional connection that we need to make with the customer. We need to be a part of that plan. That really helps us really determine whether that customer's character is the type that says, I've got, it may be I either am not managing my business well and I skip a payment, I miss a payment, but sometimes it actually, from a character standpoint, is I have a choice on what I'm going to do. Either I'm going to pay this obligation, which, again, financially I can do it. Everything worked out. All the numbers were accurate and everything just penciled out perfectly, but I am making a conscious decision today not to make that payment. And again, it all ties into character plus a plan. It really is where a bank gets its comfort. And again, when Peter was talking about how customers, you know, being a part of that, because whether or not a customer in good times they have a plan, but you also have to have a plan in bad times that says, hey, if things go wrong, if the macro economy is not what you thought it was going to be, what is the plan? Are you going to come back to the bank? Are we really a partner to figure out a way through this? And again, that really speaks to the character of the individual. On the other hand, it's also the most subjective measure, so it's also the thing that despite numbers, that a customer can really perhaps overcome face-to-face with a banker or with a credit officer.
I was going to ask you too, when you talked about character and you talked about the business owner having funds available to pay the bill or pay something else that's really important to the company. If they're open with you and they communicate with you actually what's occurring, does that help in that process? Because, you know, most business owners get to some type of cash flow crunch at one point or another in their business cycle. How does that, are you willing to work with somebody at that point, or would you prefer them to be open and honest prior to getting to that spot?
You know, the more orderly, the more planned thing to be for a bank. So the answer is absolutely yes. Both the other gentlemen have mentioned banks, we know what's going on. The numbers do speak for themselves at the end of the day. So you're not going to really be able to kind of kick the can down the street too long. I'll go to the bank early. You know what our mission is to provide capital to help a business grow and succeed. A lot of times, and that kind of ties into when do you come to the bank? The earlier point that I made about come to us early. Come to us early when, even if there is a need. Yeah, sure. Banks, you know, that adage that banks you want to lend to you when you don't need it. I wouldn't necessarily agree with that. We want to lend to you when you have a plan, whether you need it today or tomorrow or a year from now. As long as you have a clear plan and a clear connection with that banker, it makes it a lot easier. But again, to answer your question, come to the banker early. There may be solutions, may not even be traditional lending type of solutions, but there may be a solution that protects the borrower, protects the business, and frankly also protects the bank. So the earlier that conversation happens, the better.
Can we talk about industry specific? So maybe I'm in a particular industry that your bank doesn't specialize in. Are there certain types of loans for certain types of industries, and do you guys specialize? And I'll let all three of you answer, but do you specialize in a particular industry at your bank? Brian, do you want to answer that question?
Sure. And you know, the real answer is that we don't have a specific industry that we're targeting. I would call us a generalist. You know, we have customers that walk through the door every single day, and it's our goal to help each and every one of them to the extent that we can. And we have a multitude of different products available and folks that can be the trusted advisor to help them. So whether it's one of the popular industries or the less popular industries, we are looking to help as many customers as we really can in a given day.
Thank you. What about you, Peter?
Well, we are generalists as well. I would say there are, rather than there are industries that we focus on, although there are a few that we have focused on recently, whether it be in the medical dental space or such. I think there are more industries from a reputational risk perspective or from an overall risk perspective that we may want to limit exposure to. But overall, I think that the fundamentals of the business would reliably outweigh any industry risks that are out there as far as underwriting the credit. However, there are certain industries that we understand that goes to understanding the numbers. So what is a particular financial picture or what's good financials or financial metrics for one business in one industry is going to be different for another business in a different industry. So I think it really has to do not necessarily with appetite so much as to do with the individual credit of the business respective to the industry that they're in. And that is industry specific.
Absolutely.
So we do.
Go ahead. I'm sorry. Go ahead.
That's okay. We do move within many different industries, and we have many different partners with expertise in those industries we can leverage.
Yeah, that's what I was going to ask. So you use partners in the industry who are experts to help you kind of walk through what's the specific need for that business owner.
Right.
And then Daniel, are there any medical programs, or are there programs for medical professionals or others that can help someone get a loan?
There sure are, and that is one of our specialty areas is medical professionals, so doctors, veterinarians, dentists. What we basically do, if you look at a balance sheet for an individual who's a doctor or oftentimes a dentist, especially earlier on in the career, it's really heavily weighted toward debt. If you look at it from purely ratio analysis, that really, the numbers may not look great, but what's missing on there is the value of the degree or the value of the medical license or dental license. So we do have special programs that'll take that into consideration and kind of give a proxy value to that license that says, hey, this is worth some amount. It's not shown on your balance sheet as an asset. To what Brian and Peter were both saying, we feel the same way though from the standpoint of we love pretty much anybody that's going to pay us back. I would say the industries that we do like, again, we have a special niche with medical and dental, manufacturers, employers. I mean, we're Americans first, so we do want to be a catalyst for growth in the economy. We're patriots at the end of the day. And I would also say that those kind of operating businesses with numerous employees and lots of different activity, those are things that maybe go beyond just pure lending that says, where can a bank add value from a standpoint of cash management, cash flow analysis, cash flow management. There may be things that we can put in place, some banking products or banking services that can help a customer's cash position that don't necessarily involve lending. And the nice thing about that is if we can bring that kind of a solution to the business, it's a freebie. I mean, they make that extra money going forward forever, and they never have to pay us back.
Absolutely. Thank you. Brian, what opportunities are banks offering borrowers? How can SBOs work to get a better deal?
Sure. We're offering a multitude of products, and really, when it comes down to different opportunities and options that you have, it's great to work with your banker and your bank to explore those. I can't tell you the number of small business owners that I talk to that just aren't aware of the opportunities that they have. We have a complete suite of products, which, not to talk too much about our products, but it could be anything from loans to credit cards. You've all heard what's in your wallet. But we've got the Spark card for small businesses that really helps in a number of ways. We have microfinancing relationships that we work with different microfinancers such as Kiva. So there's a lot of different options that a small business owner can look to, and multiple ways that they can get the capital that they need. It doesn't always have to start with or end with a loan. And I think Daniel alluded to it. Sometimes banks, we really look to say genuinely, how can we add value in our communities? How can we help small businesses grow? It's not always a loan with that bank. Sometimes it is a partnership. But certainly talk to your bank about the different options that you have, because everything from getting the business card early on to getting the very large real estate loan as you've grown in all stages of the life cycle, we can craft a solution, and especially with those that work with us, and that we really reward loyalty and the depth of that relationship, and we look to craft unique solutions, unique pricing, unique opportunities for those customers, and help them continue to grow and invest. That's what we're passionate about. That's what it's all about.
Thank you. I was going to ask you too. So if I go to a bank and am I getting turned down and I don't get the funds that I need, do you guys partner locally with other alternative lenders or organizations, whether it's SCORE, whether it's SBA, locally to help them get more advice to be more prepared the next time?
Definitely, definitely. We want to see everybody succeed. I know that sounds odd. Some people think that we only want to lend to those who don't need the money, as I've heard a couple of times. That's really not the case. We want to see your business succeed. We want to see you grow. And so we do partner with micro-lending organizations. You mentioned SCORE, small business development companies. Those are some really great free opportunities for businesses to get business plan assistance, to talk with retired professionals. There are other micro-lenders. I've mentioned that a couple times, but there are community groups that specialize in filling that gap, helping you gain small amounts of capital before you can come back to the bank and you've established your business. So that's in everybody's best interest. Certainly we invest in those. Certainly we have those relationships. And if we can't help you, we're definitely going to point you to some partners within the community that might be able to help you.
One of the questions I'd been getting from small business owners was, does my corporate structure play an impact in terms of how much money I can borrow?
The corporate structure is an interesting one because it's more of a legal and an accounting construct than how you operate your business. So there are advantages, and I'm not an attorney and I'm not an accountant, so I won't give that type of advice. I will say from a banker's standpoint that there are certain structures and organizations we want to see you have within your business that just shows that you've got your eye on the ball, that you're managing the business correctly. I think most people would agree that it's very difficult to run a $3 million sole proprietorship. There are complexities, there are licensing depending on your industry. So there are times when the sole proprietorship just begins to outlive its usefulness. As a corporation, a limited liability corporation, an S corp, a partnership, you name it, I'm not sure that we really have a strong opinion on which one of those is best. I think it's what suits your business and making sure that you're making appropriate decisions for your long term, for the succession of the business, whether it's partners or family, taking care of your personal assets as well as your business assets. That's where the structure comes in, and it goes back to a theme that we've talked about all along: being prepared, understanding your needs, and then explaining that. And that's how we would answer that question.
Good, thank you. Peter, I was going to ask you, so I come to you as a small business owner, I'm new, I've been in business a couple of years. Why do I need to have a personal guarantee? Why do I have to guarantee the individual loan? How can I begin to separate the two, that I no longer have to do that?
Well, that's actually a great question. It does come up quite often, and I think I alluded to that earlier, in the sense that the personal guarantee is one of those things that is as much symbolic as it is structural for the bank. If you're not willing to stand behind your business, it can become a circular conversation, because the rationale for not having to give a personal guarantee is that the business is so strong. That's also the rationale why you shouldn't care if you give one anyway, because the business is so strong. But we want to know that you are as invested as the bank is in your business. At the same time, with the small business owner is the business. We're investing in you as the small business owner. So it's important to recognize that the business may be very successful. Then the question then becomes, is the business going to be as successful if you're no longer associated with it? Or should something happen? And I think that's one of the things, as a business grows from a small sole proprietor, what Brian had talked about, growing in size and complexity, things like succession planning and life insurance and matters such as that start to become part of the credit understanding process, because when you start talking about a corporation, you start talking about an entity which will outlive the business owner, and the relationship could potentially outlive the business owner as well with the bank. So we need to know that there's a plan in place. At the end of the day, I think the most important thing to recognize when we're talking about providing credit is that it's not our money we're lending, it's your money we're lending. So we need to, although some folks kind of forgot that about 7 years ago, 8 years ago, forgot that rule. But at the end of the day, we're all risk mitigators. We're risk managers in its finest component. And what we need to do is we're trusted with safeguarding the money that you deposit with us, and you want to make sure we're making as sound a business decision as we hope the small business owner is as well. So the personal guarantee is very important. I would also like to add, with regards to providing, something that Brian talked about, partnering with community groups. I think it's essential in the small business or the medium-sized business within the marketplace to understand that there are these other groups out there, and the banker, once again, we keep saying this, it's really important to understand, should be your trusted advisor. It doesn't matter if you just have a deposit account or if you just have a credit card or something with that bank. Form a relationship with your banker, because he is the one or she who understands who these community partners are, who these players are, and we keep talking about, the best time to ask for funds is when you don't need it. I will counter that with saying you always need the funds. You may not just realize that you need the funds.
Absolutely. So, Daniel, what is one piece of advice that you would give to, based on all the years of your experience in this industry, what is the one piece of advice that you would give a small business owner in order to run their business successfully, that you've seen pitfalls in terms of being able to hold up to their obligations? What would be your one piece of advice that you would give to anyone?
I would say be transparent, be passionate about your business, run your business, and maker. When I say depression, it's not an audition. When you come to for leads, it's not an audition. You have to be perfect. You have to be good, and you have to have the passion. You have to really understand what you're doing and how your business runs. But the one piece of advice really is to pair with the banker, and really there are solutions. To the issue of personal guarantee, for example, the ultimate lack of a personal guarantee was the mortgage industry. And if you think of how much different that entire economy might have been over the last 7, 8 years, leaving would have had a conversation with their banker, not the bank, but with their banker, and said, here's where things are going, help me through this. So again, that's one of the reasons why we want a personal guarantee is, hey, if things don't work out, you're going to come to us and we can work it out together. So again, transparency is the #1 for me.
Thank you. What about you, Brian? What would you say?
I think it's to be true to yourself. I know that sounds a little cliche, but you got into business, you started it originally because of what you believed in. And you believed in yourself and your idea and how you were going to help people, or some people just want to make money. But you really believed in it, and I think as you make decisions long term, don't lose sight of that. Don't lose sight of who you are, because ultimately that's going to be your guiding star to help your business be successful. Daniel, I couldn't agree more. Speak with your trusted advisors. The banker is one of those trusted advisors, but keep a close network of those trusted advisors to help you continue to mold that. But be true to yourself. Make sure that that business always resembles what you always wanted it to be.
I think that we see that a lot. We have somebody who has, they love to cook, and all of a sudden they've got this passion to open up a restaurant, and now everything they learned and loved with cooking they now despise because they weren't necessarily a business owner. They were a cook or a chef, and so we do see that a lot. Peter, what would be your best advice to give to a small business owner based on all your experience?
I think it would depend on where you are in the process. I would certainly say transparency is one of them, and understanding your business. I would also say, with regards to, managing your business, to your point, it's something you're going to be doing a lot, spending a lot of hours in. So you have to have a passion for what you're doing. I think as you're going through the process with your banker as well, whether it's good times or bad times. And if it's good times, everything's great, right? When things start to become a challenge, I think responsiveness is also something we haven't touched on. You know, a bank is there to help you, and the only time I find when the situation starts to deteriorate is when there's lack of responsiveness. When the bank isn't getting the answers they need when they need them. It's not, maybe, it may not be the answer I want to hear, but at least get me an answer, and we can work with our clients. And that has to do with any point in the genesis of the loan process, at the beginning or in the middle, if we're having some challenges and we need to help you kind of work your way out of the debt, and then hopefully get you back on your feet and get you back, you know, into some sort of credit facility. We need some responsiveness. It's when we don't hear from a client who's having some challenges that we tend to, and that goes not just with banks, that goes with any other industry or any sector. I think that's the biggest challenge folks make with the IRS, is they don't pick up the phone. And then that's when the things like the liens and the judgments and all that stuff starts coming, not because of you're having a financial challenge, because you're not being responsive to the inquiry. So I would say responsiveness is really one of the things throughout the whole process that's going to help the process be, and openness is going to help the process be a lot easier and, you know, dare I say, a little enjoyable for the client and the banker.
We always get the feedback from small business owners that they're intimidated in going to the bigger banks, that, you know, they haven't been in business long enough. They feel like they'll get turned down. So I think, you know, by talking to you guys today, you know, you've actually opened up about a lot of the things. You know, you seem the guys next door, you know, you could feel open, and everybody is passionate when they first start their business. Everyone thinks that they can be successful, and to have a partner that can point me in the right direction with the local resources, to have a partner that can explain to me how important my personal credit history has been, what your expectations are over the next, you know, short-term period, but moving forward, and continually mentoring these small business owners as small business advocates. Those are going to be the things that allow these small business owners access to the capital that they need. And sometimes they don't even know that they need to hire in certain areas of their business so that they can focus on what they're best at. And so in meeting with your traditional lenders, in meeting with your bank to get that access to capital that you need, you can actually probably also sit down and give insight into, this is a gap within your particular business, but if you were to hire here, then you can go sell more and bring in more revenue and expand your business and be more competitive and be more marketable and all of those things. So I certainly appreciate you guys taking the time today. We look forward to doing many more of these, and hopefully you'll be able to join. And at the end of the day, we think that, you know, by partnering with Dun & Bradstreet Credibility Corp, we're actually trying to help small businesses understand how important not only business credit is, but also understanding the different types of capital available to the small business owner. So thank you very much for your time.
Thank you.
Great. Thank you.
Thank you, guys.
Thanks for having us.